Most traders lose money in a trend. Not in a range. In a trend. That sounds backwards, so let it sit for a second. A trend is the easiest condition the market ever gives you, and most people still find a way to bleed inside it. Why? Because they enter at the wrong point. They chase the move after it has already run. They jump in on the breakout candle, watch it stall, and then sit through the pullback that was always coming. By the time price actually resumes, they are underwater, second-guessing, and closing early. You do not need to trade that way. There is a simpler point of entry, and it is one you can test on any chart, going back years, in about 20 minutes. This is the 20% pullback. It is not a Fibonacci number. It is not exotic. It is a retracement of roughly 20 to 30% of the most recent impulse leg, inside an established trend, at a location the market is likely to respect. Simple does not mean weak. Simple means repeatable. And repeatable is what turns a strategy into an edge. Let's define the market condition first, because a setup without a condition is just a hope. You need a clean directional trend. Look at the higher time frame, the 4-hour or the daily. You want a clear sequence of higher highs and higher lows if you are buying, or lower highs and lower lows if you are selling. This is basic market structure, but it is the filter that keeps you out of choppy, directionless charts where this setup simply does not work. If you cannot draw the structure in 5 seconds, the trend is not clean enough. Skip it. Once the trend is confirmed, mark the most recent impulse leg. That is the strong, decisive move that pushed structure forward. Measure from the start of that leg to its high, if you are in an uptrend. Now watch for price to retrace back into the 20 to 30% zone of that leg. Not 50. Not 61.8. 20 to 30. Why this zone specifically? Because a pullback this shallow tells you something important. It tells you the buyers never really left. A deep retracement often signals exhaustion or a change in control. A shallow one signals conviction. The trend is resting, not reversing. Here is where most traders make their first mistake. They see price touch that zone and they buy immediately. Don't. Touching a zone is not permission. You need a trigger, and the trigger is a market structure shift on the lower time frame. Drop down to the 15-minute or the 5-minute chart once price enters your 20 to 30% zone. Watch for a break of the most recent minor lower high. That break, on the lower time frame, inside your zone, is your entry signal. It confirms that the retracement has ended and the trend has resumed. You are not guessing that the pullback is over. You are watching it end in real time. There is a second confirmation worth layering in, and this is where the 50-period exponential moving average earns its place. In a healthy trend, price will often respect this average as dynamic support. If your 20 to 30% zone lines up with the 50 EMA, you now have two independent tools agreeing on the same location. That confluence matters. One signal can be noise. Two aligned signals, from two different methods, are much harder to dismiss as coincidence. Now, the stop loss. Place it below the low of the pullback structure, with a small buffer beyond the most recent swing low the market carved out during the retracement. Not below round numbers. Not at some arbitrary distance. Below structure. If price trades back through that level, your read on the pullback was wrong, and you want to be out, not hoping. This keeps your risk defined and tied directly to the chart, not to your emotions. For the target, use the prior high of the trend as your first take profit level. This is your structure-based target, the most recent point where price previously turned. If the trend is strong and momentum is expanding, you can trail the remainder of the position using the same 50 EMA, exiting only when price closes decisively below it on your entry time frame. This lets winners run without needing you to predict exactly where the move ends. Trade management matters as much as entry. Once price moves in your favor by an amount equal to your initial risk, move your stop to break even. This is not about being clever. It is about protecting capital so a single bad trade cannot undo 3 good ones. Beyond that, resist the urge to manage the trade every 5 minutes. Overmanagement is its own form of self-sabotage. You built the plan before you were in the trade, emotionally neutral. Trust that version of yourself over the one currently watching the candles print. Now, when should you leave this setup alone entirely? First, if the higher time frame trend is unclear, or price is chopping sideways without a clean structure. Second, if the retracement blows through 50% and keeps going. That is no longer a shallow pullback. That is a warning that the trend may be losing control, and this setup no longer applies. Third, avoid this setup directly ahead of major news events. A clean technical structure means very little in the 90 seconds around a central bank decision or a major data release. The setup is not wrong in those moments. It is simply irrelevant, because volatility from the news will overwhelm the structure. What causes traders to lose money on this exact setup, even when it is a good one? Mostly impatience. They see the zone, and they enter before the lower time frame confirms the shift. They are trading the level, not the trigger. Others do the opposite mistake. They wait for so much confirmation that price has already resumed the trend and run halfway to the target before they finally click buy. The edge here lives in the balance. Wait for structure to break on the lower time frame. Enter close to that break. Don't wait for comfort, because comfort arrives late, and late is expensive. There's also the mistake of moving your stop loss further away when price approaches it. If price is testing your stop, your read was likely wrong. Widening the stop does not make the trade correct. It just makes losing more expensive. Respect the level you set when you were thinking clearly. One more thing worth saying plainly. This setup will not work every time. No setup does. What makes it useful is that when it fails small, because your stop is tied to structure. And when it works, it tends to work in your favor by 2, 3, sometimes 4 times your risk, because you're entering early in a resumed trend rather than late in an exhausted one. That ratio, over a large enough sample, is what builds consistency. Not any single trade. The sample. Before you trade this live, go back through your charts. Find 10 instances of a clean trend, a 20 to 30% pullback, and a lower time frame structure break. Mark the entries. Mark the stops. Mark the targets. Do this without money on the line first. You are not trying to prove the strategy works in theory. You are training your eyes to recognize it instantly, so that when it appears on a live chart, you are not hesitating or hoping. You are simply executing a pattern you have already seen 100 times before. So return to where we started. Most traders lose money in a trend, not because the trend is difficult, but because they never had a precise, testable way to enter it. Now you do.